The views that you'll be hearing during today's program are those of our speakers and not of Stratford, the speakers' companies, firms, or clients, and they are not intended to provide legal advice. We're very pleased to have gathered an authoritative panel of experienced broker-dealer audit experts to explain and analyze the inspection process and to give practical solutions to help you head off problems before they are discovered by inspectors. Our panel today includes Kevin Briard, Managing Partner at Briard & Associates in Northridge, California, and he's joined today by John T. Haig, Financial Services Industry Leader at McGladrey in Chicago. So gentlemen, whenever you're ready, we'll go ahead and we can get started.
Well, good morning. This is Kevin Briard to the West Coast. I know it's high noon in the central swath of the United States, and a very good afternoon to the East Coast. John and I have worked very hard here to give you a presentation. Sometimes I think I fly about 5 miles above the subject and John about 5 feet. So together we'll be able to illuminate you and discuss some of these issues. I have gone to 3 of the PCAOB conferences, and I also have been one of the lucky people to have been selected for the PCAOB review of our work papers. So we have a little bit of experience on our side. If I take a look at the first slide, we're on page 6, broker-dealer audits tackling the pervasive deficiencies identified by PCAOB. PCAOB has had 2 inspection reports. So John decided and I that I would handle the first inspection report and John the second. And John's going to chip in here and there in my presentation to add his wisdom and insight. I will talk a little bit towards the end of the presentation about challenges to anticipate, and I also will discuss some best practices. All right, moving on to the next slide. So I ask you, are CPA firms' deficiencies on the PCAOB's radar? Are they concerned about what we're doing, and have they took note? Well, last month, Louis Aguilar mentioned in early February, he had an opening speech to the SEC. I only want to pull a couple lines out of it, and I won't do too much reading off the slides, but I think we do need to pay attention to these 4 sentences. Additional concerns were raised by the PCAOB's 2013 progress report on the interim inspection program for firms that audit broker-dealers. The report noted that 95% of the audits selected for inspection had deficiencies. In fact, deficiencies were noted in 1 or more of the audits conducted by each of the firms inspected. It is particularly troubling that in 37% of the broker-dealers selected for inspection, auditors appear to have been involved in the preparation of the very financial statements they audited, a violation of the independence rules required by the SEC. So, as John and I prepared for this presentation, we said to ourselves, well, I don't know if our mothers would be happy to know that 95% of the work we do has deficiencies. But we're up against a tall order here, and certainly we haven't done ourselves any favor. When you look at the 37% of the broker-dealer audit selected that the independence issue has come up, I mean, that has been a big surprise to PCAOB. And in fact, as you can see, 1 out of every 3. So this is quite alarming. Okay. Well, now that we have PCAOB's concern, is the PCAOB funded for their mission to take a look at us? And just the last 2 sentences I'll read from Mr. Aguilar's speech. Today we consider the PCAOB's budget, and he'll go on to say that he believes the PCAOB has demonstrated an ability to use their resources prudently. So we're on their radar, and their guns are loaded, and they're looking for us. So we have to be very careful out there. So let's go to the next slide. And so I ask you, how many of us out there, how many CPA firms are auditing broker-dealers with the SEC as of December 31st, 2011? I don't think the numbers changed too much between 2011 and 2012, but are there 800? Are there 1,000? Are there 1,250? Or are there 1,500? Well, believe it or not, there's only about 800 CPA firms that audit broker-dealers. And on page 12 of the slide here, that one of the PCA releases in the summer of this year, or August of 2013, it talks about the 800 firms that audit broker-dealers. Now, John and I are both firms that are in that top tier, more than 100 broker-dealers on a yearly basis. So not that we're incredibly experts in this area, but we see a lot and we feel a lot, and we're been involved in a lot of these broker-dealers on an annual basis. But when you look at that slide that I just had, almost 50% of the audits are prepared by one-off firms, and that's a concern to PCAOB and FINRA. And the first two tiers of the other slide, if I go back to it, as you can see, the first two tiers over, the firms that do 5 or less is greater than 80%. So there's a concern out there by PCAOB as if the auditors who are auditing broker-dealers really understand what they're doing. Next slide. I wanted to give you an overview between the inspection reports. The first inspection report came out in August of 2012. The next one in August of 2013, and I have no idea the next one's coming out in 2014. But you can see the number of firms has risen substantially. The first time around, the number of firms looked at were 10. Then we go to 43. Then we go to 60. And the number of audits, as you can see, has graded up every time. Well, the next slide here on page 15 is actually a slide for one of the PCAOB conferences. Now, I did that for two reasons. One, thought it was a good slide. And two, this is tax season, so I didn't have a lot of time to prepare other slides. This is an overview of inspection report number 1, the 12 deficiencies they noted, and it's in all areas. The first 4 areas, the report on material inadequacies, we would know that is the internal control report. The testing of the exemptions claimed, the customer protection rule, and the net cap rule, they like to call those 4 areas audit deficiencies related to the customer protection and net capital rules. The next couple, starting with fraud, related parties, revenue, and you can see the next couple on the screen, those are all audits related to the financial statement audit. And in the very end there is the green, the independence issue, and I think it's in green just so it stands out there saying, man, we're pretty surprised this thing came out. If we go to next slide, 16, I just wanted to focus in on the last areas. And you can see by the bar chart and this wonderful graphic depiction that revenue is a big concern in each of these audits. And likewise, if you look, the evaluation of control deficiencies is the least of their concerns. So I thought this was a very good overall representation of what the first inspection report looked like.
Hey, Kevin, it's John. Let me just add that the second inspection had pretty much the same percentages of exceptions as the first inspection, except for independence, which you've already talked about, and that significantly spiked.
Well, thank you. Thank you. So when I go to page 17, this is off the inspection report, and we have some of our broker-dealers have to comply to Rule 15C 3-3, and that's the customer protection rule, and that's the rule where if a broker-dealer is holding a customer's securities or holding funds of a client, usually these are the brokers whose net cap is $250,000 or more. Now, the first time they looked at the customer protection report, the audit reports tested were 14, the insufficient procedures were 14, so we have a 100% failure the first time. Going to the next slide, again, I wanted to bring up the first time, the first slide I looked at was those clients who customer protection wasn't an issue, and now they're going to have some clients who customer protection is an issue. In other words, we have a broker-dealer that is $250,000. They are holding securities. And this is coming right from PCAOB. PCAOB's observation is when a reserve was required, they're finding that the CPA firms aren't digging down to see the bank account is to the exclusive benefit of the customer, and the right restrictive provisions are on that bank account. So they're finding problems there. And, hey, Kelly, you want to take over here?
Yes, I do. Hi, everybody. I am Kelly. I'm your moderator, and it is time for our first verification code for those of you who are seeking continuing education credits. Again, this is verification code number 1, and just a reminder, you do need to write this code down on your official attendance form for today if you would like to receive credit for CPE. So your first code is the letter T, the number 1, the letter F, the number 4, another F, and the number 6. Again, that code is T as in Tango, the number 1, F as in Foxtrot, the number 4, another F as in Foxtrot, and finally the number 6. And this is your first verification code.
Kevin, if I may add a couple comments as it relates to the customer protection.
Yes.
I've seen situations where sometimes the bank seems to think that they could use the account as collateral. That is not allowed, or attach any claim to the account, which is also not allowed. So your point about it being designated with the correct nomenclature and the fact that they keep those accounts separate from the operating accounts of the broker-dealer is incredibly important. It's also important that the auditor identify that and document that in their work papers.
Yeah, thank you. I think they also came out and they want a bank to be where the reserve account is held, and not to be held at another broker-dealer. Do you want to enlighten us, John, on that?
No, that is correct. That is correct.
Okay.
They're leaning towards that and working on rules to finalize that.
Okay, so as auditors, we should be aware of that they really want that reserve account to be separate and distinct from all the other clearing accounts that the broker-dealer may have. Okay, we're on page 20 here of the slides. Areas of high risk noted by PCAOB in their inspection. The net capital rules, and specifically they're saying, look, at the auditors failed to test the components of net capital, and I'll talk a little more about that so we can drill down. And fair value, insufficient procedures, and I'll drill down on that. So the very first one I talked about, what does it mean I failed to test the components of net cap? Well, the insufficient testing, the area would be haircuts. And let's, as an example, say a haircut on a money market account should be 2%. In the world of FINRA, that haircut is 2%. It's not 2.5%, it's not 3%, it's 2%. And a lot of times when you have CDs at a bank when it matures, it has a schedule of when it becomes more liquid, where the haircuts are. Now, there's not big haircuts on a CD at a bank, but there are haircuts if it's a long-term CD hold, we'll say a year. Other areas where auditors, we didn't do sufficient testing on net capital with a classification between allowable and non-allowable. And also, where the case where we have a early warning notification. And just to help a early warning notification, well, that means that the firm is somewhere within 120% of their net capital. So if you had a broker-dealer with a net capital of $5,000, 120% of that is $6,000. So anywhere between $5,000 and $6,000 is your early warning notification. FINRA does like to see that as a note in the financial statements when we discuss the net capital, and our firm will note that a broker-dealer is in early warning. And I think, John, you mentioned that one CPA firm got in trouble for not mentioning the early warning notice?
That is correct. So they're looking for a sufficient footnote that details what the net capital is, what the requirement is, and includes something as it relates to the early warning amount, so that a financial statement reader would understand exactly how close to that early warning amount that broker-dealer is.
Thank you.
Now, before you move on, I've got some comments there at the 5-foot level.
Please.
A couple of things that we've seen and experienced in our individual examinations by the PCAOB gets down to documentation. And I wanted to stress the fact that when you're testing haircut percentages, there should be a clear reference to the relevant sections of Rule 15C31. When you're looking at the allowable and non-allowable, again, the documentation should include a reference to the sections of the rule. Operational charges, make sure they're appropriate by referencing the rules. Same thing with haircuts and whatnot. The other thing that I'd suggest people might do is to review the clearing broker agreement for the PAIB language if they do any trading themselves, to make sure that that is consistent with the operations of the broker-dealer.
Yeah, thank you. Yeah, that PAIB, proprietary account of an introducing broker-dealer, is very important, because it could be that the money the broker-dealer has sitting at the clearing firm maybe isn't allowable. There could be those strange occurrences.
And the last word there is I'd suggest that everybody review the regulatory correspondence to see if the regulators have noted any instances of non-compliance with the net capital rules.
Very good. The next slide, what does insufficient procedures mean for fair value measurement? And this is where PCAOB found that firms fail to test the valuation of securities. So what that means is you have, or as auditors, we're looking at a firm, we see they're holding securities, we say, oh, great, they're being held at Wedbush, looks good, I don't have to test any of these. So we need to test the values. We just can't accept the values that the clearing firm gives us. It almost sounds like the auditors just kind of rolled over and did nothing in this area. So we need to beef up our game, and we need to test the valuation of the securities.
And again, Kevin, that gets into the documentation. We have to obtain an understanding of how management makes these estimates and document that, including the methods and the models they use, the assumptions that are underlying any accounting estimates, and the data on which the estimate is based on. All of that needs to be documented. Yes,
and man, when we go to the level 3 and we have such difficulties with how management is getting their values, and for publicly held companies, I think there has to be a little disclosure, and I imagine eventually for the broker-dealer levels that our firm audits, the private firms, I imagine we're going to have some more wording when they have level 3 and how that valuation is determined. Alrighty, on slide 23, the number one problem PCAOB noted in the inspection report was revenue recognition. So the CPA firms are, according to PCAOB, and it's nice just to grab their slide, we didn't perform sufficient audit procedures to test the revenue recognition. Test all material classes of revenue transaction. And what that means is you may have a broker-dealer that does some proprietary trading, maybe does some soft dollars, maybe has four or five lines of revenue. So the PCAOB found that we're not testing all material classes of revenue, maybe just testing one or two. And the other observation PCAOB made was auditors did not verify the commission rates.
And again, if you don't mind, at the 5-foot level, and we're playing this off pretty well here, again, it gets down to documentation as it relates to responses to the relevant assertions as it relates to revenue. So occurrence, completeness, accuracy, a huge one that you've mentioned, cutoff, and classification. And if the auditor, and this is very important, if the auditor does not overcome the presumption that revenue recognition is an actual fraud risk, then the auditor needs to include a test of details as part of its substance procedures. That's key. They are requiring us to basically take a sample of revenue transactions that are representative of the underlying population and make sure that we get an understanding of that. And in addition, they're pushing towards, there have been some instances of where firms didn't perform what they would call sufficient substantive analytical procedures, another very important audit procedure.
Yeah, that's a good point. I was talking to an older gentleman who had been doing audits for a number of years, and he said, you know, Kevin, we used to do audits. We just tested the heck out of the balance sheet. It sounds like now I have to test some of the profit and loss statement and the revenue. Yep, you got to do that. So revenue recognition, number one on the hit list here. The second thing would be the area of fraud, and John, I'm going to leave that for you, but I did want to talk about the third area that they noted, which was establishing a basis for reliance on records and reports. For us as auditors, we had that SAS 70 report, SAE 16 is now the new nomenclature. And we were, as auditors at PCAOB, made the observation that we grabbed these service reports and we dropped them in our binder and really didn't do anything with them. And we got to look at these reports. We got to look at the control risks. When I go to next page 25, you know, PCAOB is making the observation that we failed to evaluate these reports. And we really need to look at how the design and operation effectiveness of the controls being relied upon. We need to take a look at this portion. I've heard at conferences where PCAOB has mentioned, even if you have some of these wonderful SAS 70 controls that are mentioned, you may want to take a look at how many of their sample size is there, and you may want to make an assessment whether you can rely on it or not. So this is an area where PCAOB says, look, you got the report, but you need to evaluate it. And if I go to the next slide, and this is the last slide in this area, they're talking about these service reports, and I was trying to see here on the service reports. Oh, it's actually the next slide over. Over here, just so if I had to talk about audit evidence AU 326, just because many of us don't know those new references, they're talking just that we just don't get enough audit evidence. And I always like examples. And close to the end there, they do have an example which I think is nice for audit evidence. They say, for example, in auditing revenue by applying standard prices to records of sales volume, the auditor should consider the accuracy of the price information and the completeness and accuracy of the sales volume data. So that's what they're saying for us to drill down, take a look at the evidence, make sure it's right. And the next slide is what I was thinking more about. These service organization reports, PCAOB has got to make the observation, and it's in the first paragraph, close to the end, that the auditor can't use these reports to reduce the assessed level of control risk as low or moderate. And I think there was an idea that these service reports were the panacea, and that if the clearing firm is reporting everything accurately for us and we can rely on those SAS 70 reports, we could reduce some of our risk as auditors. And that's simply not the vision or the view that PCAOB has on this. John, do you have anything you want to add to that?
Yeah, I got almost like a case study, because here's a situation that I've seen in real life and heard about in the inspection process. There was a CPA firm that had a fully substantive audit approach, and when they gained an understanding of the controls, they determined that the broker-dealer records their revenue based on clearing broker statements. And two situations, one where this SSAE 16 report was not obtained and one where it was obtained. In the situation where it was not obtained, the auditor basically got confirmation from the clearing organization or the other broker-dealer or whatnot, and it was determined by the PCAOB that that was simply a tracing exercise and not necessarily a test of the accuracy of the transactions to test the completeness of the population. So you can't just do that. And in the situation where they did get a SOC 1 report, the confirmation would have been an acceptable substantive procedure if you did the user controls and otherwise tested the accuracy and completeness of the transactions if the SOC 1 report did not cover that. So it's, as you've started, this is a critically important area. The PCAOB is focusing on this, and again, old school. You used to be able to trace these numbers back to the external party and use their clearing statements. That's no longer the case.
Thank you for the new world view. Our CPA firm finds that when we ask for the SAE 16 reports, usually we don't get them, or if we get them, they come too late. We get audit reports. So we have a great difficulty in getting these SAE 16s. The next slide, I wanted us to have a big overview of the 6 most common mistakes between the first inspection report and the second inspection report. On the first time around, the accountant supplemental report on material inadequacies, that begins that 2-page internal control report, number 1 problem. And the second time around, number 1 problem. And if you think about it, that report's got to go away starting June 1st, and perhaps it's no surprise. Perhaps it goes away because of all the mistakes that the PCAOB inspections found in this report. The second most common mistake we have to be cognizant of is revenue recognition. That happened the first time around. That happened the second time around. Consideration of risk of material misstatement due to fraud. It was your bronze medal winner the first time around and the second time around. The next page, establishing a basis for reliance on records and reports. We just went through that. That came up the same. The only thing that really switched here was number 5 and number 6. Related parties came up number 5, and that would switch to number 6 in the next report. So, and then the financial statement disclosure. So those are the top 6 areas. Hey, it's verification code time. Kelly?
Hi, everybody. It's time for your favorite part of the program, I'm sure, verification code number 2. Again, this is your second code, and this code is the word cable. That's cable spelled C-A-B-L-E. Again, the code is C as in Charlie, A as in Alpha, B as in Bravo, L as in Lima, and E as in Echo. Again, that word is cable, and you'll need to write this down on your official record of attendance form for continuing education credits for today's program. All right, with that, I'm going to turn it back over to our speakers.
I think this is a nice segue in for John to take over.
Thank you, Kevin and Kelly. Let's see here. There we go. And that was a good segue between the first inspection report and second inspection report, Kevin. They have identified certain key things that they're looking for in the conduct of the audit, and I figured now might be a good time to break away from some of the detail and talk about the inspection program in and of itself. Obviously, the objectives are to assess compliance of auditors as they comply to Rule 17A5 and professional standards and their own standards. And also to determine when and how the permanent inspection program will begin and how it's conducted. Everybody should know that right now the PCAOB is basically considering this inspection program to be a temporary program. The findings of the inspections have not been included for public dissemination as part of their issuer reports of firms that do SEC registrants. So it's not public knowledge, other than the fact that they have prepared these summary reports the last 2 years, and we would anticipate another one next summer as it relates to the most recent inspection. Now, we should all know that the SEC and the PCAOB have new rules that become effective in June. What we understand based on informal conversations with the PCAOB is that the 2013 inspection program, i.e. the audits that were just completed, will be conducted under a temporary inspection program similar to the last two. Now, 2014, calendar year 2014 examinations filed with the SEC at the end of February 2015, we understand that will also be under the temporary inspection program, because we believe the PCAOB would like to continue that temporary inspection mindset under the new standards. And then the thought would be the 2015 audit cycle, the inspection done by the board in 2016 would be considered under their permanent inspection program, which would, at that point in time, I believe, result in reports that would be available for the public by firm, either added to the issuer report or kept separate, depending on that accounting firm's other business. So that's what we anticipate. Now, obviously, that can change. And that, I think, is a fair progression of how we adopt the new rules, both as broker-dealers and the accounting profession. I also wanted to talk about this process. Think of the PCAOB looking at an examination of auditors' work papers as similar to an audit exam. So they would pre-screen, i.e. get the underlying financial statements and any other available information that was out there about the firm that the CPA firm audited. They would plan their inspection. They would communicate that and schedule that. They would then actually have a planning week in their offices as compared to the CPA firm's offices to identify, in their opinion, those areas of high audit risk of material misstatements within the financial statements. They would read the financial statements. They would read anything else that is out there, inspection reports that are publicly available. They would look at the Form BD and get other information as it relates to the broker-dealer. They would then conduct their inspection. Most of the inspections that we've been through, and from what I understand, are between 3 and 5 days. They would then wrap up and provide comments to the CPA firm at the end of that week. Then they would issue a formal report and allow for the firm to respond, and then to consider the reporting process as it relates to accumulating all those findings. Now, this is a slide that is based on my perception of what they're looking for when they conduct an inspection. And as Kevin has alluded, based on the findings, it is fair to say that I would think that in all inspections they would look at those things like revenue recognition, related party transactions, obviously net capital, customer protection, and then fraud/journal entries. So I would imagine that in each inspection they're going to be looking at that. They would also sit back and, based on the broker-dealer's operations, potentially look at other key areas which would result from their assessment of the risk and the financial statements, the net capital standing, etc. So that's kind of their focus areas. The team structure is a situation where they have a planning team that may be greater than the actual people that are involved in the inspection, as they apply their resources and their expertise and experiences to make sure that their examination or investigation is as good as possible. Then the inspection team, and then there's, just like a CPA firm, there's their own set of reviewers, their technical reviewers that will look at the results of their inspection and provide final comments and come to final conclusions as to whether or not there were deficiencies or not. All right, let's talk about independence. In the second examination, there were, as Kevin alluded to, 37% of examinations that were deficient. 3 of which, surprisingly enough, were conducted by auditors of issuers. And you would think that those firms would probably know these independence rules better than not, but those deficiencies were noted. We need to remember that auditors or broker-dealers are subject to SEC independent requirements, Reg SX, and the key issue here gets down to financial statement preparation. So Kevin and I talked about this at a webcast a couple months ago, and I think we surprised a bunch of people on the phone as to what auditors can and can't do. And I'm going to run through a laundry list of what we think is the interpretation by the board as it relates to what we can and can't do as a profession. We cannot provide the client with what I'll call a style guide or pro forma financial statements. We shouldn't even be giving them pro forma prior year financial statements. We can't help them group accounts into financial statement lines. We certainly can't help them draft their footnotes. We can't help them make changes to their prepared financial statements other than maybe proofing changes and dot the I, cross the T, take a comma out, that kind of stuff. We can't provide the client with journal entries that are not audit adjustments, including gross-up entries. And we can't provide the client with templates. And what I'm talking about there is, for instance, tax provision templates or valuation templates or any other work sheets that would provide efficiency to our clients to get through maybe some robust accounting issues, because then effectively we're auditing our own worksheet, which gets us into a situation where we're not independent. So that's a high-level review of the independence concerns. Kevin, do you have any other overarching comments as it relates there too?
Yes, I have spoken to 2 firms in the United States that have breached the independence rules, and so much so that it's been referred up to SEC. So this is very serious territory that we're walking in.
All right. Figured I'd throw a question out here to amplify my prior comment. The FinOp asked the engagement team for help in calculating deferred taxes. The engagement team informs them they can't do it, but they give the FinOp a template that they created as it relates to how to perform that function. And under the SEC rules and under the PCAOB oversight, that would be a problem as it relates to our independence. Okay, let's move on to accountant supplemental report on material inadequacies. And as Kevin alluded to, there were exceptions in 43 of the 60 audits. Deficiencies related to whether or not there was a reasonable assurance that any existing material inadequacies would be disclosed. Talking about the exemption claimed under the Rule 15C33, and I'm going to talk about that in a little bit more detail in a second here. Whether or not there was a proper evaluation of the reported net capital deficiencies as an indicator of a material inadequacy. And there what I'm talking about is a situation that if you had a net capital deficiency, does that automatically trigger a material inadequacy in the internal control letter or not? The evaluation of an error in the net capital computation, should that be considered as an indicator of a material inadequacy? And if you can believe this, the timely notification of material inadequacy to the SEC and FINRA. As everybody should be aware, there are some very precise timing requirements as to when you identify an MI, who reports it, and how soon it gets reported to the regulators. Let me go back to the exemption claimed under Rule 15C33, because I think that may have been the biggest issue as it relates to these deficiencies. So most of our clients that Kevin referred to, and most of our clients, to the people on the phone, probably have filed the 15C33 exemption, the financial statements, as if they had an exemption from those rules. And a lot of times the auditor would, knowing the broker-dealer's business, because of familiarity or looking at the revenue stream and whatnot, would simply inquire as to whether or not the firm was truly exempt from 15C33. And it's clear to me that the board has basically said that inquiry is not enough audit evidence to come to that conclusion. So what we've done is basically decided that we need to actually obtain and document an understanding of their operations in relation to the exemption that is actually claimed, review the broker-dealer's policies and procedures related to the prompt remittance of cash and securities, simple stuff like obtaining and reviewing the membership agreement with FINRA and compare that to the exemption that's claimed. Examine the broker-dealer's books and records for evidence of activities outside of those that are mentioned, i.e. different revenue streams. Perform procedures around cash and securities, and this is key. This is something the board really wanted us to do, to test if the broker-dealer has transferred cash and securities to a clearing firm within the appropriate amount of time. Obviously, examine the books and records for the evidence of the special account for the exclusive benefit of customers. And other things. Review regulatory correspondence to see if the regulators have noted any instances of non-compliance, and review the clearing agreement to determine the type of arrangement they have with the clearing broker-dealer. So those are some simple things as it relates to 15C33. It is key that inquiry is not enough. And documentation of all these factors should be in the work papers. And that's probably going to be more critical, and maybe, Kevin, you can talk about this for a second, as it relates to the new rules, as it relates to the exemption report and how that drives the lack of a need of a compliance report, et cetera.
Yeah, I think maybe an example that perhaps a lot of us audit, the little $5,000 broker-dealer, we call them the little nickel broker-dealers. And, John, we had used this example last time. A little nickel broker-dealer can do up to 10 proprietary trades a year. If he goes over that, does 100 trades a year, he's no longer a $5,000 broker-dealer. He's probably a $100,000 broker-dealer. So to dovetail what you're saying, John, is we would want to make sure that the broker-dealer as a nickel BD isn't in the active marketplace of trading securities. They should not be in that position. So that would help support that they are claiming the right exemption provision. Okay.
Let's move on. Material misstatement due to fraud. 37 deficiencies in the 60 they looked at, and typically those deficiencies were related to the fact that the auditor didn't necessarily respond to the fraud risk that they had actually identified in the planning process. And this is the second one is key. The presumption that revenue recognition is a fraud risk, and they also challenged us on the sufficiency and execution of journal entry testing. So some thoughts related there as it relates to journal entry testing. The auditor really needs to consider fraud risk that they've identified during planning, including revenue recognition, and document that audit response. Now, that is going to drive which populations they're going to test. Once they determine the population of series of transactions or accounts they're going to look at, they need to be very careful in assessing the completeness of the population, so that they can make sure that they are deriving the right sample. And the selection process needs to be robust. It needs to be focused on the risk of material misstatements that could be created by fraud. And it can't just be those journal entries that exceed materiality. It can't just be those issues that are old school as it relates to fraud. There really has to be a robust discussion as to where the risks are for fraud, what accounts that affects, what population of transactions goes through those accounts, and how to determine a sufficient sample size to do that. Kevin, have you had any experience in that regard?
Yes, I have, and just a couple comments. On the journal entry testing, there was a time when CPA firms would say, review journal entries, essentially looks good, nothing unusual noted. Going to these PCAOB conferences, they hate that response. They don't understand that response. That response should not be used. As John's alluding to, you need to be selective in what you're looking at, and you need to be more demonstrative in what you're looking at. I mean, if their journal entries posting monthly revenue, then their monthly journal entries doing that. But you need to look at the journal entries. I would also add, we do our risks, and I know that in our firm will have, hey, these are our audit risks. And I know when PCAOB came in, they said, hey, great, Kevin, you identified your audit risk. In other words, I showed him my Achilles heel. But I didn't do enough there in that capacity to overcome all those risks. So a word to the wise, you need to link the dots there. If you see the risks, you got to be demonstrative in how you're going to minimize those risks in the audit.
Thanks, Kevin.
Thanks, John.
One final comment would be to make sure that you certainly look at journal entries as it relates to the end of any quarter, or basically any month, any quarter, or certainly at the end of the fiscal year. As it relates to the fact that those may be the entries that are more subject to management override of the internal control processes, and et cetera. All right. Related party transactions, 25 deficiencies out of 60. You'd be surprised to find out that there were certain situations where actually no procedures were performed. Situations where the existence and the identification of the related parties and the related party transactions was not documented. And even when they've identified the related parties, that there was not enough sufficient audit work done as it relates to the actual transactions between the related parties. It's critical that when you determine the existence of related parties, the auditor needs to perform procedures beyond inquiry to test the completeness of related parties identified by management and then document the results. Ideas would be to inspect bank and legal confirmations to see if anything comes out of those confirmations that would indicate that there's a related party. Review minutes of management or board meetings to see if there are transactions or relationships that are identified in those documents that may indicate that there are other related parties. And be very cognizant and continually have professional skepticism as it looks to identify other related parties throughout the rest of the audit work that is completed.
John, I was going to comment on the related party transactions, that a lot of the audits that we perform, we see this expense sharing agreement between the broker-dealer and perhaps the parent. And sometimes that's allocating office space and the like. And so we've tried as auditors say, well, it looks like the broker-dealer's in 30% and the parent's in 70%. So that's some of the work that we've done. Sometimes when we do an audit, when the client will say, hey, this will be a real easy audit, which we all know is a red flag. This will be a real easy audit because we have an expense sharing agreement and not a lot of checks written. Well, as time goes on, every time I hear there's an expense sharing agreement, I say, wow, I've got a lot more work to do. I wish the broker-dealer just cut its own check and have its own office as a standalone.
That is a critical point, Kevin. Thanks for reminding me of that issue. That was identified in the 4 examinations we've been through in the last 2 years as a critical audit step, because think about the fact that a related party who's writing all the checks can allocate those amount of expenses to a broker-dealer to allow that broker-dealer to maintain its net capital compliance, et cetera, et cetera. So the heretofore, we would be looking for that agreement, and now management needs to be able to support their allocation, and we need to test that allocation. And that is one of the critical findings that came out of the most recent inspection. All right. Establishing a basis for reliance on records and reports. Kevin, you've kind of alluded to this. Any report that the broker-dealer uses as its books and records, we need to test whether or not management is assured that that report is complete and accurate. And if they don't have the internal controls in place to test that, and we don't test those controls or test whether or not we think those reports are complete and accurate, then there's an issue as it relates to the board's processes and the way we look at we do our audits. Okay. Evaluation of internal control deficiencies in the financial statements. We've identified 6 of 60, but these were pretty critical as it relates to the severity of the control deficiency and the evaluation. Here I'll just make comments that for considerations for the group. If the auditor has identified a misstatement, whether it's uncorrected or subsequently corrected, doesn't matter. The auditor needs to document whether control deficiency exists related to each misstatement. And after all the control deficiencies are identified, they need to make a decision and document whether or not they should be evaluated to determine the severity individually and in the aggregate. And again, this is important to focus on as to whether or not we think that any of the exceptions we find in the audit are pervasive enough to basically say that the broker-dealer could run afoul of either customer protection rules or the net capital rules. Final thought is, if the audit adjustment is a material amount and the auditor concludes that this is not a material weaknesses, he or she had better have some robust documentation in the work paper file that documents his or her rationale that that is not a material inadequacy. All right, audited financial statements. 29 out of 60 audits were there, and that's where the PCAOB is not necessarily looking at the audit procedures that were performed, but they would cite the profession as it relates to the fact that there were errors or omissions in the financial statements that the auditor should have caught as part of their audit procedures. Examples would be omitted disclosures, inaccurate or incomplete disclosures, and a lot of these 29 were related to the not having robust enough fair value disclosures under the more recent accounting pronouncements that have come out. Moving on, understanding the entity and its environment when performing the audit. Surprisingly enough, there were several deficiencies where we just thought it was a simple broker-dealer, and we didn't obtain and document an understanding of the entity and its internal control structure, so that we would have the foundation to design the nature, extent, and timing of the audit procedures. And this gets back to proper planning. The auditor has to effectively design their audit procedures that are responsive to the risk of material misstatements that are identified for each engagement. So the old school thing of beating the crap out of the balance sheet, excuse me for my slang, and looking at the net capital computation is not sufficient audit evidence. All right, just a couple more slides for me. The auditor's report, surprisingly enough, there were 21 exceptions out of 60 because either the auditor didn't have the right report on the supporting schedules or had errors in its report as it relates to the supplemental report on the material inadequacies. So surprisingly enough, we had issues as it relates to our own report, which is the one thing that we could control. Kevin, I'm going to slide this thing back to you after Kelly comes in.
Yes.
Yep. Well, before we slide things back to Kevin, it's time for our third verification code. So audience, this is verification code number 3, and your code word is dash, D-A-S-H. Again, this is code number 3, and the word is dash. So D as in Delta, A as in Alpha, S as in Sierra, and H as in Hotel. So I'll give you just a few moments to write down the third verification code, which is dash, before we continue with our presentation. All right, it's time to move on to the presentation. Gentlemen?
Well, thank you. So we're going to pick up here on slide 47, and I'm going to try to cover the challenges we're going to need to anticipate in this new world order we're in. The first thing that our firm has realized that the client-prepared financial statements elongates the whole audit cycle. We understand that as auditors, we never should have been preparing the financial statements. You have the de jure and the de facto, the spirit of the law and the fact of the law, and I think some firms cross that line. The problem is that a lot of the clients that we audit, the mom and the pops, they have $250,000 in revenue, and they don't really know how to prepare a financial statement. You would say that these rules for the SEC are for publicly held companies that have critical mass, and a lot of the clients that we audit simply aren't that. They don't have over 500 employees, very, very small companies. As John has talked to about, we really need to significantly increase the documentation in our audit steps. We might have been doing this work before. We might have been looking at the focus to see whether things were allowable or not allowable. But if you look at a sheet of paper and you don't put any tick marks on it, then it's really not indicative that you've done anything. So we need to significantly increase what we are doing. And, man, we're going to have, starting June 1st, completely new reports. We're going to have the exemption. We're going to have the compliance report. And this is going to translate to some more time and some fee increases. When I began the presentation, I talked about there were about 800 CPA firms doing broker-dealers, and a couple firms were some one-offs. And I think there's some of these one-off firms have just haven't done the rest of us a favor. A case story, I talked to a broker-dealer who had his audit and his tax return done for $1,800. Now, that doesn't even approach the retainer for his audit. So there's been a lot of firms out there that weren't really living up to the spirit of the rules. So it makes it more difficult when you're going to say, well, I understand the guy never came here, but we're going to spend a couple of days here looking and making sure everything is properly accounted for. So we're going to probably have some pushback on fees. When I did read the PCAOB report, they did throw a number out there, $3,000 for the additional cost that it may take to do some of the smaller reports. The exemption reports. But, we're going to have to actually see. We're all going to be in a whole new learning phase. And then, to try to synergize this, looking at the I'm sorry, John, do you want to comment here?
Yeah, I wanted to add some color to that.
Sure.
They said $3,000 for an exempt broker-dealer.
Yeah.
Let's not forget the fact that when the board was created and Sarbanes-Oxley came out, they estimated that the additional cost for a public issuer would be around $96,000. It's close to, I think it was $90,000 to $100,000. When we all know that the additional fees to be compliant with those new internal control testing standards was well into the millions. Now, I'm not going to suggest that the same ratio is going to apply for an exempt broker-dealer, but there are a couple factors that are going to raise the cost of doing an audit. One perfect example is the fact that the board is going to require that on each engagement there's an independent engagement quality review. And we talked about this in our last presentation, Kevin. Heretofore, our firm's policies would never require a second set of eyes by another independent partner to look at the audit file and allow those financial statement reports to be issued. That is a requirement, and that has to be done by a partner of the firm. And that is going to add a significant cost to do those audits. So, unfortunately, there's going to be some significant fee increases that are going to be passed on, and it's sometimes going to be very difficult to be able to defend those fee increases to a client where they don't necessarily see the amount of effort or the quality of the audit increase. But the professional standards are what they are, and Kevin, as you know, you and I are not going to walk away from our professional standards.
Yes. Well, thank you for the color on that. I wanted to talk briefly about some best practices. I've noted 3 best practices. Understanding that one of the problems that PCAOB found was on net cap that the auditors failed to test components of the net capital computation. As John has already said, we really need to document our procedures, and our firm has added work program steps to our audit program. We've beefed up our audit program. We have a whole new page just on testing net capital. You may want to put some tick marks on your focus that you retested the haircuts. So it's demonstrative, again, that the proper allocation between allowable and non-allowable and the haircuts have been tested, that we just haven't rolled over as auditors and just accepted these numbers. Item number 2, the fair value. Insufficient procedures is what PCAOB noted. In our firm, we go to the Wall Street Journal, WSJ.com, to document the price and do our comparison test. That is now very demonstrative in what we're doing. And I think the thing that we're all just fighting and really having a hard time with is the preparation of the financial statements. And we found a couple ways, not around it, but ways to deal with it. And in terms of best practices, one of the things that we have done is we actually have another CPA firm prepare the financial statements. We prepare the audit, and another firm prepares the financial statements that the broker-dealer pays that CPA firm to prepare the financial statements. We take a look at the financial statements to make sure everything is fine. We're very grateful that the firm that we refer is capable in the world of broker-dealers. The other thing is I myself am a FinOp, and a lot of times maybe the FinOp should stand up and help prepare the financial statements. Heck, they do them quarterly for the focus, or they may even be doing them monthly for focus. So to ask the FinOp to do the groupings shouldn't be all that difficult because he or she already does that. And my other point, my other observation is some of the QuickBook reports, and that's, again, a lot of what our clientele uses. A lot of the QuickBook reports are not that bad, and we may have our clients submit as a financial statement the QuickBook report. QuickBooks does do a cash flow. It may be about 95% right to 55% right. Beginning and ending cash will work. sometimes items that should be in finance or up in operating, or things that are investing or are in the wrong place. But by and large, the client can then export that cash flow statement from the QuickBooks and polish it out. Because that's what our firm has seen as one of the biggest headaches, is when the firm has to end up doing that cash flow. So these are just a couple of my observations in best practice. John, do you have any comments here?
No, I think you've adequately covered this, and throughout our presentation, I think we've given some tips to folks as to how they can best make sure that their files are complete with the documentation, so that there can be a conclusion that we've obtained the sufficient evidence to be able to issue our report.
Well, very good. The last portion I wanted to cover is the PCAOB disciplinary process. And this is a very serious process, and PCAOB is flexing its muscles. I'm going to share about 3 slides with you, and they're all from the PCAOB. Just as an observation, the PCAOB, may investigate these violations, and of course the areas that they can take a look at is relevant provisions of SARBOX, the rules of the board. But the third bullet on there is what we all have to pull up our chair and pay attention to. The provisions of the security law relating to the preparation and issuance of audit reports. I begin the presentation talking about what's on their radar, and I'm trying to end this presentation on what's talking on their radar. This is just not gossip. It's right there on the whiteboard for them to take a look at. Now, when you take a look at what PCAOB can do, they can refer up to enforcement. And areas where enforcement gets involved, well, we got illegal acts known to the auditor and some unethical conduct by the auditors, departures from PCAOB standards or departures from GAAP. And where I have talked to a couple people now is the failure to cooperate with the inspection, which is not really a good path to take. And again, potential independence violations. This is very much on their radar. And then the last area in terms of the common types of investigations, the next slide here, is in terms of violation of the professional standards. And a violation of professional standard is gathering insufficient audit evidence. And in this new world where we need to be beating up on revenue a little more, you're not going to have a good argument to whip in that area. The other area professional standards are going to take a look at is due care and professional skepticism, where you're ignoring any kind of red flags. Other areas of investigation is a failure of the firm's quality control to operate effectively. Heck, number 2, independence violations. I wish I could ring a little bell over here how many times I've talked about that today. And as I mentioned earlier, failure to cooperate with an inspection or an investigation. When you go through the PCAOB review, they're going to have areas of matters of further consideration, MFCs, and you need to answer these obviously with as much dignity and respect, and perhaps learn through the process. I think what we're learning through the process, as I've mentioned, we need to document things, and some of the old habits of ticking in time, accepting numbers, just will not work in the New World Order. So that's my portion of the presentation. Kelly, I can throw it back to you.
Sure, thank you. So as we move forward, I think we're actually up to our 4th verification code at this time. So audience, this is verification code number 4, as I said. Again, not to beat a dead horse, but invariably somebody will get confused about the official record of attendance form, and I would hate for anyone out there listening today to have any problems with it. So please make sure that you are writing these codes down on that form in their proper places. And with that, let's move into our verification code 4. This is the word earth, E-A-R-T-H. Again, that's earth, and it is spelled E as in echo, A as in alpha, R as in Romeo, T as in tango, and H as in hotel. Again, that's the word earth, and that is your 4th verification code for today. All right. Well, I see that in the last few moments we have had some questions come in. So we're going to start with our question and answer session. And to our audience, this is, something of a conversation. So please feel free to send more questions in as we move forward. A lot of times the questions will generate additional discussion. Before we get started with the question and answer session, I would like, of course, to thank our hosts, John Haig and Kevin Briard, for your insights today. To our audience, before I start to answer your questions, let me just go over some reminders to how you can participate today, and also to remind everyone that you do need to remain on the line throughout the entirety of the Q&A session in order to earn your full CPE credits for this program. In order to participate in the Q&A, there's a few different ways in which you can do so. First, you can email your questions to accountingquestion@straffordpub.com. Again, that's accountingquestion@straffordpub.com. Second, you can you can submit questions to us by typing the question into the Q&A box, which is on the left-hand side of your screen, and then you just simply click send. And finally, you can also ask questions via telephone. To do so, you'll simply press star and the number 1 on your touch-tone phone. Again, that's the star symbol and the number 1. And then you'll be entered into our question queue. If for any reason you later decide that you would not like to ask a question, you can simply press star 1 again, and you'll be exited from the question queue. Once you're in the queue and when it's your turn to ask a question, the operator will announce the first name and the city for the person who's registered at your location. If you'd like to go ahead and identify yourself further at that time, please feel free to do so, and then you'll simply ask your question. All right, I think that covers our instructions for this portion of the program. So I'm going to begin with our first question. All right, gentlemen, our first question asks, what are your thoughts on an auditor providing a financial statement template to the client so that there's not a lot of back and forth between the two on the presentation, because that can take a lot of time? Is that something that's acceptable, or does that start to get into independence issues?
Well, John, I think you kind of touched on that. It's a kind of a frown on giving the clients a template to help them. Do you want to speak to that?
Yeah, I mean, that's right. And even so bad that based on our conversations with the board, they thought that us giving a client last year's financial statements pro forma for them to drop in this year's numbers would be a potential exception to the rules. There's very little tolerance in this area.
Okay. We have a lot of questions on independence, so I just want to preface this discussion with that. The next question asks us, what would you do to avoid independence problems in the case of a very small broker-dealer, i.e. one bookkeeper with a limited skill set beyond recording transactions?
Unfortunately, it's going to raise potentially the cost of them doing business, but Kevin put a best practice out there that basically said hire a small CPA firm or CPA that understands financial statement preparation, give them the trial balance, and have them prepare financial statements. Let's not forget that the AICPA has issued a fairly robust audit guide for broker-dealers that does have sample financial statements in there. That guide is updated annually, and I would suggest that you present that. I don't think that's an issue if you present that to your clients, as that's not going to impair your independence.
Yeah, I was just going to add, I feel for this. We have clients who are one-man shops. I would also add that when PCAOB came through and we had that 2-page internal control letter, they wanted us to note that it was an internal control problem for there to be a one-man shop, and we asked the PCAOB, who are we telling this to? that the clients that work with the firm know he's a one-man shop, and but this again is an area that there's no leeway in. Whether you're a one-man broker-dealer or you're a 100-man broker-dealer, we're all at the same rules of having the independence at the highest level.
Okay. So our next question might actually be a pretty natural follow-up to this discussion. And the question asks, what is the impact to the broker-dealers and to the financial statement if the auditor is deemed to have violated independence rules?
Oh, well, now, if the auditor has deemed to violate independence rules, he should step away from the audit. You know, John, I've seen where the auditor has violated independence rules on a publicly held level, and those audits have had to be those entities have had to be re-audited.
That's exactly right, and which then puts the broker-dealer at risk for not meeting the required deadlines, et cetera. One good piece of news, now that we're talking about independence, and I don't know if this question's come up, I believe that the board has backed away from its proposal as it relates to tax services that we can provide for those people that are in a financial reporting role working for our broker-dealers. It appears that the board will allow us to maintain or provide those services, which was different than their original proposal. So there was a little bit of relief there, acknowledging the fact that several of our clients nationwide are small, and it makes sense that the CPA firm that's doing the audit can also do the tax return of the principals.
Yeah, it was somewhat confusing to tell the clients we're no longer your one-stop shop. I can't do your taxes anymore because of independence issues. So it's nice to see that they relaxed that in that area.
Okay, let's see. What is our next question? All right, our next question asks if you could please confirm that providing tax compliance services to broker-dealers such as tax return preparation does not impair their independence, which I think, ironically, is what you just mentioned.
That is correct.
All right, so we'll move along to our next question, which also is dealing with independence. In regards to maintaining independence, this person asks, when it comes to preparing the financials, is it okay to read the client's first pass of the report and then offer handwritten comments?
As long as, again, this is in the eye of the beholder, as long as we're not writing footnotes for our clients, I believe that you can provide some guidance. But then you have to get into a situation, and Kevin, help me out here. If we identify, let's say, 4 holes in the footnotes where there's not adequate disclosure or it doesn't meet the standards, not only if you help the client or you potentially piercing the independence rules, you almost have to sit back and say, is this a significant weakness, material weakness in the internal control structure that they can't prepare their own financial statements in accordance with the GAAP? So we have to be very, very careful here.
Yeah, we walk that same theme over here. If a client can't prepare their own financial statements, oh my gosh, do we really have a problem here? So that is a very fine line we walk. The question was, does the client give you their financial statement, and are we making comments off of it? Well, our firm is. Sometimes we'll shoot of all things, an email over and say, some areas need to be beefed up, or take a look at the AICPA guide as it relates to this area. We try to guide them in the right direction.
Okay. We just had a question come in that I believe relates to not this answer that you just gave, but our previous issue regarding independence and doing tax returns, and it's just a clarification on that point. So I'd like to go to that. They'd like to clarify, did you say that it is permissible to do the tax return of principals, but what about that for the company?
You can do both.
You can do both.
Yeah.
Okay.
There was an issue where potentially audit firm could not do the CFOs or anyone in the C-suite's tax returns. But as John mentioned, that has fallen by the wayside.
Okay. Let's see. Let me get back into the list of questions. Okay, so our next question says, or asks rather, can we assemble and bind financial statements for our clients along with our report without impacting independence? We do not draft any part of the financial statements.
Yes, you can be the work processing engine that would put their financial statements along with our opinion for filing with the regulators.
Yeah, we view it the same way over here. We can be the assembler of the information, but at that point we're acting no more than like a Kinko's or any kind of outside service. It's just printing and binding and very much on the administrative level.
Now, Kevin, our firm actually does, and we didn't seem to have too much angst with the board. We would actually prepare and well, I got to be careful here. We would act as the word processing. The client would give us a draft of their financial statements, and we would take over the typing of those financial statements, making it very clear within a bunch of email documentation as to traffic as to what we received and whatnot. But we do participate in the word processing.
Yeah, I would like to say in our firm, we don't. We don't want any part of that. We want no audit trail to that. That whole ball of wax now is in the client's. And, we may be a little extreme on that. Sometimes the PCAOB takes extreme positions. So we're just trying to be as clean as we can in this environment. And maybe, John, to everyone listening, maybe PCAOB, actually, the independence rules are the SEC. So It really is the SEC that we need to talk about it in this area. We need to talk to the SEC and getting their interpretations. That's where this comes from.
Okay. Before we move on, I am going to go ahead and give our next verification code for the audience. So let's see. This is verification code number 5 for everyone who's listening. Bear with me because this is not a word. This verification code is a series of letters, so I will read that out for you. It is PAAYDC. Again, the verification code number 5 is the letter T as in Tango, then the letter A as in Alpha, a second A as in Alpha, the letter Y as in Yankee, D as in Delta, and C as in Charlie. Again, it's verification code 5, and the code is PAAYDC. Okay, we will now transition back into our question and answer. Just give me one moment to pull up our list of questions. All right, our next question, okay, this is a long one, so bear with me here. I believe this is regarding related party transactions. They ask when the broker-dealer pays an allocated expense amount, is the auditor required to obtain and test detail from the parent company records, such as invoices, etc., or the parent company financial statements to agree with the expense amount by category from the parent financial statement to the allocation schedule sufficient, along with gaining an understanding of the methodology of the allocation and the testing consistency and changes based on current year operations?
Well, that was a mouthful. Kevin?
Yeah, I mean, we really need to test these expense sharing agreements. I can tell you from the real world that oftentimes I have been stymied by a client where we're allocating payroll from the parent, and often they won't really let me have the records of the parent. They'll say, well, the payroll is $1 million, but I really want to see it. So I've had some problems getting some of that information, and the person who wrote the question in, I understand your perspective because we have a related party expense being allocated, rent, but yet we need to get to those documents to make sure the right expense is being allocated. It's difficult. It's difficult. Sometimes some of the expenses that have been allocated from the parent might be $100 of a phone bill, and we as auditors are looking at pretty much an idle broker-dealer, and we know that because we'll say revenue's under $100,000 and they just haven't done any deals. So some of the times when we look at the allocations to the parent, we're looking if it's reasonable. As you just heard me say, $100 a month for telephone for an idle broker-dealer makes sense. I don't know if $1,000 would. So hopefully that helps a little bit.
Well, let me add some color. I am aware of a situation where a broker-dealer, the board has come in and determined that the auditor did not have sufficient evidence to deal with that issue. And it was effectively related to this very question as to the inability to get access to the records at the parent company level. Unfortunately, here's a situation where the board also has the ability to take the broker-dealer to the SEC and advise the SEC that there may be an issue with books and records or net capital compliance, just like they can take the firm to the SEC. So the broker-dealer needs to be advised that they effectively have to provide that underlying information so that the auditor can test it, because if they don't, then they're putting themselves at risk to the extent that the SEC may be knocking on their door next.
Okay. Thank you for that answer. Let's see. Our next question. One moment. Let me pull this up. All right. Our next question asks, are you aware of a timeline for illustrative guidance or other direction on the form and substance of the exemption or compliance report?
They did a couple months ago, I think in October of last year, they did come out with number 1 and number 2, John, I forget what they're called now, that do have the exemption reports in them and the compliance report.
Yeah, there were new PCAOB standards that did come out that covered both of that. As to whether or not there's going to be practice aids or not, I don't believe so. I think they're relying on the CPA profession to properly educate their clients as to what's there, and relying on the CPA firms to adjust their audit procedures to make sure they're compliant with those standards.
Okay, thank you. Our next question asks, have you adjusted your documentation to support the client / FNIOP, I apologize if I'm pronouncing that incorrectly, is preparing the financial statement? For example, email including the draft financial statement, account grouping updates, journal entries, etc.
Well, as I kind of briefly alluded to before, we're still agreeing to be the typer of the financial statements, and so in so doing, we are very careful about maintaining email documentation and other documentation as to what we have received from our clients to satisfy the fact that they are preparing their financials versus us. So yes, our documentation has increased.
And, for us, we're just trying to make it as clean as possible. We're not doing any of that. It's completely in the client's ballpark or the FinOps ballpark or the other CPA firm. Because I can see in our environment where we could perhaps have a problem with that. And so, again, we're just staying clear of it as a best practice.
Okay. Let's see what our next question is asking. So our next question asks, it's relating to second partner review, and it asks, when will the second partner review go into effect, and is there a small firm exception?
Don't laugh, Kevin. It's not funny.
All right, John.
There is no exception, and there will be effective for audits for 2014.
Anything else?
No, I think
I can't be any more blunt than that.
Yeah, I mean, those are the rules. I mean, among us in the profession, we've talked about, I wish there was an exception for revenue below a certain point or total assets under a certain point. But all that is wishful thinking. We all have to play by these rules, and they're all equal rules to everybody.
Okay. Our next question says, can we provide a disclosure checklist to the client for them to determine the completeness of their financial statement disclosures, or would this run into independence issues?
Our firm has decided that would come too close to piercing the independence veil, and we have decided not to do that.
On the pragmatic level of the broker-dealers we're working with, we have not given them the 30-page checklist. So that's what we're doing here.
And again, Kevin's comment about these are basically SEC independence rules that we have to adhere to. If it was a public issuer, we wouldn't be providing a checklist to them, and so the same rules apply. Again, I refer back to the fact that there is a fairly robust practice aid out there or audit guide out there that's going to get you 99% of the way towards the required disclosures.
Okay. Let's see, our next question. We got an email in, and I believe this is regarding audit evidence. They ask if you could provide a little bit of information about quote-unquote sufficient procedures in order to, how you ensure that you're using sufficient procedures.
Well, that's an open question. I'll start. If there's a number on a work paper and it doesn't have a tick mark on it with reference to a rule or making an indication is the amount of testing that was performed, then you're at risk of not having sufficient audit evidence in the files. And I know that sounds harsh, but as Kevin alluded to, we've a couple of years ago we'd have a net capital computation in there, and we didn't have a tick mark next to the minimum requirement on the work paper, and that was a finding. Kevin, any thoughts?
No, not really. Just more documentation, more beating up on areas.
Make sure in your planning process that you've identified all risk of material misstatements and including fraud risks. Make sure that is the starting point as it relates to your determination and documentation of the extent, nature, and testing of the work you're going to do in the sampling area, and make sure that you have very good documentation as to the population, how you've tested that population for completeness and accuracy, and your determination of that sampling, et cetera, et cetera.
I mean, as a pragmatic matter, we find that the small broker-dealers who do the M&A deals, the mergers and acquisitions, we find that they have a terrible time of recognizing revenue on a timely basis. So, so making sure revenue is recorded in the right period as an audit step will actually go into January and make sure that the revenue in January belongs in January. Maybe it should be pulled back into December. As auditors, we're used to doing a search for unrecorded liabilities. We're the Monday morning quarterbacking. We're looking at, if we have a December year-end, we look at January, just look at the disbursements. Well, for us, we've expanded to make sure that revenue is recorded in the right period. We've expanded to looking in January for revenue as an additional test to ensure revenue is correctly reported in the right period.
Yeah. And to get back to the question at hand, if you don't have any documentation in the file, then it's presumed that you did not do the work.
Yes. Yep.
Okay. Any other thoughts on that topic?
Nope.
All right. Well, to our audience, let me just take a break to remind everyone that there are a few different ways that you can participate. I see that we've had a question about calling in. So just a reminder, for those of you who'd like to call in your questions on the telephone, to do so, you would simply press the star symbol and the number 1 on your touch-tone phone, and that will enter you into our question queue. When it's your turn to ask the question, the operator will come on the line and they will announce both the first name and the city for the person who's registered at your location. At that time, it's up to you to ask your question. If you'd like to, you can identify yourself further, and then you would just simply ask your question, and we would answer it for you on the line. So that is how you participate via telephone. And of course, you can always also participate. We've had a number of people type in their questions into the Q&A box. That's on the left-hand side of your screen. It's under the Attendees tab, and then within there's another tab for Q&A. You simply go in there, type in your question, hit enter, and that populates in real time. Or, of course, you can also send your questions in to our email address, which is accountingquestion@straffordpub.com. So just a little refresher, those are the various ways that you can participate in our Q&A. That being said, let me move on to our next question that we've received. Let's see. Have we already had the question asking if you can provide the disclosure checklist to the clients to help them determine the completeness? Okay, good. All right. Our next question says, if there is no template to present to the client, won't the presentation of a McGladrey-type audit report look completely different?
I'm not so sure. I'm not sure I understand that question. Could you read it again?
Yeah, I'm not so sure I understand either. The question asks...
I think what they're saying, John, is if McGladrey's not going to provide a template, that then means that the financial statements are going to look a little different from one broker-dealer to another if there isn't like a standard template. I think that's what the question's saying.
And certainly there is that flexibility, and that could actually happen. But that, if the client prepares their financial statements and we don't effectively provide some typing services related thereto, and the presentation and disclosures fit professional standards as relates to being in accordance with GAAP, then we would throw our opinion on it and then move forward.
For our firm, we like to adhere to the AICPA's book on grouping, like for the profit and loss, the 5 or 6 categories. The 5 or 6 categories closely match what is on the focus, but in the new world order of the client preparing their financial statements, we're accepting QuickBook runs as a financial statement report, which is not going to have all the groupings. I mean, it's got to have 14 to 22 lines, and it's not going to be the neat little 5 lines. And so we're seeing some of the things that we thought were very quality-orientated because they adhered to the AICPA book. We're just not having that. And even some of the CPAs here in the office, feel like it's just still the same quality product that we're putting out. So that's just a perspective from this side of the fence.
All right, thank you. Let's see, our next question asks, if you could you please give examples of how you perform substantive tests of a broker-dealer's exemption under 15C3-3, and this is in regards to the prompt remittance of a customer's funds, i.e. by noon the next day, for certain types of exemptions.
Well, certainly we would get an understanding of their policies and procedures. Then we would corroborate that through inquiry, observation, and to make sure that they're following those procedures on a test basis. I hate to be so simple, but Kevin, any thoughts?
Yeah, I mean, I don't know if this is really an area of substantive testing. It is a bit of compliance testing there. It is a bit of inquiry. I mean, we did have a client one time keep securities for a couple days in a drawer in their office. And I mean, in a perfect world, maybe everything gets logged in on Monday and we would have seen something go out on a Friday to the clearing firm. But I think the substantive testing is really kind of hard in this area, John.
I would agree.
All right, thank you for that answer. Our next question asks, could you provide some clarity on best practices in the area of detailed testing revenue transactions, particularly what extent of procedures are considered necessary to satisfy PCAOB standards?
Well, for the revenue testing, as I mentioned, make sure that if the client has 4 or 5 lines of revenue and their material, that you test all lines, all revenue. And a lot of that testing for us is substantive testing. John, do you want to enlighten us?
No, I think that's a good start. There is, because there's such a focus by the board on revenue, you have to document that you've had an understanding of the revenue cycles that your client has. It gets back to a little bit of what I said, and within each one of those line items, determine as to how you're going to test those, be it analytical procedures, detailed transactions, cutoff testing, and again, it gets back into the assertions. You need to think about tests that will satisfy the occurrence, completeness, accuracy, cutoff, and classification of each of those cycles.
To To add a little more color, I'm thinking of one of the broker-dealers that we audit that has some soft dollar arrangements whereby there's liabilities on the broker-dealer's balance sheet at the end of the year. And in the past, we didn't confirm those liabilities, but now we are to ensure that revenue is being correctly reported in the right period. So we've added a confirmation process to ensure that revenue is recorded in the right period.
Okay, thank you. Let's see. Our next question asks, if templates were provided during the previous year's audits, which the client continues to use to draft their financial statements, is our independence impaired in the current year?
Well, that's a tough one, but I will say I think you're okay. Now, having said that, God forbid, do not update those templates. You know, if the rules change, I'll take something simple, valuation. If you gave something to them 4 years ago before 157 was so robust in the levels 1, 2, and 3 disclosures, don't help them fix it. So that's off the top of my head, but I gotta believe that past sins would be forgiven.
Yeah, my opinion on that is we were working under, well, I shouldn't say we're working under different rules, because according to PCAOB, we've always been under the independence rules of the SEC. But let's just say we're working in different times. So I think the templates you gave your clients when you could give your, well, when it was a little more easier to give your clients templates, it's fine. I mean, I understand the conscience that you're going through. Gosh, 5 years ago we gave them a template, such a great template, they continue to use it to this day. Well, I mean, you really can't pull the template from the client. So I think it's okay. They have those templates you gave them from years ago. But as John said, with the caveat, you know, things do change. So we got to be careful.
Okay. Our next question comes from email. It looks like this relates to slide 34 from the presentation, which was dealing with the inspection process and the focus areas. And the question says they understand that all of the focus areas are important, but we're wondering if you could provide any insight. Is there any area or areas that they should especially emphasize or that are emphasized in inspections that they should be particularly mindful of?
Well, I think I'll revert back to the slide that Kevin had as to where the exceptions have been, but I would particularly focus on revenue recognition, net capital, customer protection, and fraud risk, including testing of journal entries, management override, et cetera. I think if you focus on those 4 main areas, you will have hit their hot buttons. Kevin, any color?
No, I think that's right. And one of the slides, I tried to hit the top 6 areas between Inspection Report 1 and 2. The first one on the inadequacy of the material, the inadequacy in the adequacy report, the old internal control report, well, we can kind of forget that. But the other 5 things that are on those slides you need to pay attention to: the revenue, the fraud, the related parties, the disclosures. Those are the highlights. Those are the things you really got to pay attention to.
Okay. Let's see. Are there any final thoughts from either of you that you'd like to share with the audience, or just points you'd like to drill down in a little bit more detail? We have about 5 minutes or so.
Well, and John, I'll start off here, and I'll just say that, you know, with the PCAOB involved, we're really got to have to up our game here. We start off a little in a deficit, understanding that 95% of the audits they looked at just aren't good. So we need to up our game. We need to increase the documentation. We need to beat up on revenue. So, and hence some of the audit fees are going to have to go up just because the requirements for us to hold our licenses and for us to do a good job will require more beating up on the financial statements.
I could not have said it any better.
All right. Well, with that, I'm going to move on to our final verification code for the audience. Audience, this is your 6th verification code, and we are back to real words again. This word is FAST. It's F-A-S-T. Again, the word is FAST, spelled F as in Foxtrot, A as in Alpha, S as in Sierra, and T as in Tango. The word is FAST, and that's your final verification code. Please make sure that you've recorded all 6 codes in their proper places on your record of attendance form. You do have instructions as to how to return that form, which were included in your conference materials. And let's see, seeing no further questions from our audience, we're going to wrap up today's presentation. Once again, I'd like to thank both of our hosts, Kevin and John, for your insights today, and to our audience for participating with us. We hope that everyone has enjoyed our national teleconference on broker-dealer audits, tackling pervasive deficiencies identified by PCAOB. If you do have a question that you didn't ask or that was not answered, you can email it directly to our presenters. Their email addresses have been included in your conference materials for your reference. To our audience, we will be sending evaluation forms to all of our attendees shortly. We ask that you please do take a moment, fill out the form, submit it back to us, and let us know how we did today. Again, I know I've mentioned this half a dozen times, but for those of you who are seeking the standard tax or accounting continuing education credits, just a reminder that you will need to have recorded all of the codes on your official record of attendance for continuing education credits form. Instructions on how to return that form are included with your conference materials, and of course you won't be receiving credit unless you do return that form with the codes written in their proper places. Today's participants can order a recorded version of this event. It is available at a special attendee price. If you're interested, please call Stratford Customer Service. The phone number is 800-926-7926, extension 10. Or you can visit Stratford's website at www.stratfordpub.com. Again, that's www.stratfordpub.com. Again, I'd just like to thank everybody very much for being with us today. Panelists, if you'll stand by for just a few moments, and to our listeners, you can end this call at any time simply by hanging up your telephone. Thank you, everybody, and goodbye.